Good evening, church. Yes, I'm an Orlando Pirates fan. So I became a member of Tshedza in 2006, which is quite a long time ago. But I became a Pirates fan in 1995. So there you have it. But I'm not here to talk to you about Orlando Pirates or about my membership of Tshedza. I'm here to talk to you about insurance, which is quite a thing. I think I really respect you for coming here, because I don't think it's common for people to take time and come and sit down and listen to someone talk about such a one boring, two unpopular, three complicated topic. So on one hand, I really respect you and I really appreciate you for taking the time to come. On the other, I am aware of my task of demystifying insurance, at least making it interesting enough to catch your attention, and removing the complexity. I think that's the harder thing. Removing the complexity so that you can then make your insurance decisions from an informed perspective. So that's what I'm going to try to do. The time is 7:05. I want to speak for like 40 minutes, so till 7:45. Who knows if I'll go over the time, but you know my intentions. I want to speak till 7:45, and then, so I won't take questions while I speak. I will, then we'll have 15 minutes for questions at the end. I'm told that even on Sabbath, there'll be time for Q&A, and some of you or most of you have my contact, so if you have further questions after this, you're welcome to contact me. So we're talking about insurance, we're talking about protecting your assets and your income. What are we going to talk about? So we're going to first cover what is financial risk and how do people normally react to financial risk. We will talk about things like how do people view financial risk, healthy ways of viewing financial risk, unhealthy ways, and then we will zoom into insurance as one way, one of many ways, by the way, of dealing with insurance, of dealing with financial risk, and then we will look at the question of how do you choose. So if you believe that insurance is the right way to deal with your particular financial risk, then the question becomes, how do you choose? I mean, there's so much choice. That's one of the biggest problems of our industry, that we give a lot of choice. And some choice, one is good because it means we can really tailor the product to your needs. But on the other hand, it raises the question, how does a normal person know what to pick? And I'll try delve into that question. Under that, there's the question of which brand. So even if you know which insurance product you need, the question is, who do you buy it from? And how do you do that? So there's a lot of questions there that, I don't aim to give you definitive answers, but to cover kind of broad guiding principles that maybe will be helpful to us. And then I want to finish off with an interesting question. Every time, so from when I was at university, it happened quite often that when insurance was mentioned, that people referred to the fact that a lot of Adventists believe, I knew this even from a young age, some Adventists believe that you shouldn't take life insurance. And as you will see, there's some very, very clear quotes from Ellen White that discourage life insurance. I don't know if you know that. So now we need to reconcile that. How do I stand in front of you as Adventists and tell you to consider life insurance when here, one of the founders of one of the leading lights of the church discourages this practice? So I will delve into that question to demystify it as well. So let's get into the meat of our discussion. One of the harsh realities of life is that bad things happen to good people. In fact, the last time I preached to you, I think it was over Zoom, I was dealing with this very question, the question of human suffering, and how do we as Christians, whom God loves, can contextualize the fact that we go through suffering. And sometimes we feel that it's the good people that often go through suffering. And Job, of course, is a great example of this. He's the one that says in Job 14, verse 1, a man who's born of a woman is few of days and full of trouble. I'm not aiming to answer the question, why do bad things happen to good people? I only want to dwell on the fact that bad things do happen to good people. So the question then is, yes, maybe there's a theological discussion about why. Our entire Sabbath School quarterly is about dealing with crucibles and trying to find meaning in the crucibles. But I want to dwell on the question of what can we do about it, the so what. Now that we know that bad things are going to happen to us, what can we do about it? This is the question. So I did say I'm going to talk about how people deal with risk, how people deal with the fact that bad things are going to happen with them. There's two extremes. The one extreme is the apathetic person who prefers to ignore the fact that his risk is going to happen to them. So this person says, it's not going to happen to me. It's the person who's got their head stuck in the sand. They see people being diagnosed with cancer, but deep down they believe it's not going to be me. You know that feeling? You see someone in a car accident, you feel sorry for them, but somehow something tells you you'll never go through that. So that's how some people deal with risk, by assuming that it's never going to happen. But listen to what the wise man Solomon says. He says, a prudent person foresees danger and takes precaution. A prudent person foresees danger and sees precaution. The simpleton, I like this word, simpleton. The simpleton goes blindly on and suffers the consequences. That's what the Bible says. That the prudent person foresees danger, doesn't assume that the danger is not going to come to them. They foresee danger and takes precaution, but the simpleton does not. On the other extreme is someone who, I don't know if you remember, there was a children's movie that came about 10 years ago, or 15 years ago. I know I was still in university, maybe, so it's longer than 15 years ago. It was called Chicken Little. The Chicken Little was running around telling everyone that the sky is going to fall. He looked at the sky and he just believed the sky is going to fall. There's a lot of Chicken Littles in the world, people who believe that tragedy is coming and tragedy is coming to them. So this person is not ignorant about risk. They kind of over catastrophize. They assume that the horrible thing will happen and they live in a state of panic. It's the other extreme of how people react to risk. But this is also not healthy. So on the one hand, it's not healthy to ignore risk, but it's also not healthy to catastrophize, to assume that, oh my God, something terrible is going to happen to me. We see in 1 Timothy 1 verse 7 that Paul is discouraging us from living in that kind of state of fear. 1 Timothy 1 verse 7 saying, God has not given us a spirit of fear, but of power and of love and of a sound mind. So on the one hand, it is unhealthy to assume that a terrible thing won't happen to you, but it's also unhealthy to assume that a terrible thing is definitely going to happen. You need a balance somewhere in between. And note that both verses, so the first verse speaks of a reasonable man, the verse we read from Proverbs. This one talks of a sound mind. So the Bible is almost recommending a rational approach to risk, which acknowledges that risk might happen, but it also acknowledges that it doesn't mean I have to live in panic. Then the question is then how should we? What is that rational approach to risk? And I'm going to rely on the Bible again. And an interesting story is found in Genesis, the example of Joseph. Joseph is in Egypt. He has lived there for a while, and then this dream comes, and he has the task of interpreting the dream, and the dream about the 7 years of plenty and the 7 years of famine. And the story, I think you know, is it's all found in Genesis chapter 41. But I like what Joseph says to Pharaoh. He says, "And now let Pharaoh look for a discerning and wise man." Again, recommending a rational approach. Let Pharaoh look for a discerning and wise man and put him in charge of the land of Egypt. Let Pharaoh appoint commissioners over the land to take a fifth of the harvest of Egypt during the 7 years of abundance. They should collect all the food of these good years that are coming and store up the grain under the authority of Pharaoh to be kept in the cities for food. The food should not be held for reserve for the country to be used during the 7 years of famine that will come upon Egypt, so that the country may not be ruined by the famine. So we see Joseph giving the Pharaoh this rational approach. What is the rational approach? Acknowledging that the years of plenty will not last forever. These years of abundance, the years of enjoyment will not last forever. And taking precautions, taking precautions during the years of abundance to ensure that when the years of famine come, you are prepared. This is what Joseph recommended to Pharaoh, to say, during the years of abundance, prepare and make sure that should the years of famine come, you are ready. And this is the recommendation to us as well, that yes, we might be living in abundance today, but we should have that maturity to know that things could happen that could threaten that enjoyment. And the question is, are you able to then continue to secure yourself and your loved ones and anything that's important to you, should the years of famine come? This is what the Bible seems to suggest as the rational approach to risk. So we're not talking about all types of risk today. We're zooming into financial risk. And my own definition of financial risk, personal financial risk for that matter, is danger that can result in the loss of income or in unplanned expenses. And these two categories are important. So in the end, when we're talking about financial risk, we want to secure our income, and then we want to prevent unplanned expenses that we cannot control. Those two. Income can be income from a job or income from a business, although I wrote this with an employed person in mind. The reason being that there's a talk on entrepreneurship on Friday, so I will assume that the risks and issues, because the risks involved in an entrepreneurial sphere are quite different and need to be treated separately. So I'll assume they're all covered on the Friday discussion. I will just focus on income as in your salary, making sure that should the years of famine come, how do you keep your salary secure? And then secondly, should the years of famine come, how do you prevent your budget being shocked by expenses that you did not plan for? This is all there is. And so the question is then, what can we do? What is the rational approach to financial risk? I think there's only four things to do about risk. One is you can accept the risk. Two, I'm going clockwise from the bottom left. You can accept the risk. Two, you can avoid it. A related thing to avoiding risk is to reduce it. So if you can't avoid it, you can reduce it, or you can transfer it to someone else. So there's two, four things. You ignore it, or you avoid it, you reduce it, or you give it to someone else. So accepting risk is if the likelihood of that risk is low enough, then there's no reason to worry about that risk, and therefore we can accept the risk. Let me give you an example. An example could be the risk that Al-Qaeda militants enter this room and kill all of us. Right? That risk exists. They could arrive now and kill all of us. But that doesn't mean we should now, therefore, appoint a committee to look into the Al-Qaeda matter, and help the church. So the risk is low enough that we can accept it and ignore it. However, the risk of someone actually coming here and stealing one of the cars is high. That one we don't accept. Hence, we have a fence around the place and we have people guarding. So already we've made a choice that there are risks that are there that we've decided are low enough to ignore and we accept. And then there's risk that we like, okay, that's not low enough to accept, therefore we must do something about it. We also accept risk if the impact of the risk is not significant. There's a risk that tonight while you sleep, you get bitten by a mosquito. That risk is quite high for some people. But you can, for most of us, not all of us, you can handle the impact. Some people can't handle the impact, but you can handle the impact, therefore you don't do anything about it. But if you lived in, let's say Zambia, where you could get malaria from mosquitoes, suddenly then the impact of the risk is not manageable, and therefore you must do something about it. So that's the logic. Although, I met a guy from Zambia who was like, well, I don't worry about malaria. You get it once or twice a year, who cares? So he was that kind of guy that even with malaria, he felt the risk was manageable. Some risks you can't accept, but can avoid. There are very few risks that you can avoid, but some risks you can avoid, and where you can avoid, you should avoid it, except if the cost of avoiding the risk again is not manageable. So I give you an example. You could make a resolution today and say, in order to avoid the risk of dying in a car accident, from today I will walk. I will not enter a car because I don't want to die in a car accident. That's one way of avoiding the risk of dying in a car accident, but the cost of avoiding is too high, right? You're no longer able to go as far as you need to go. You're no longer able to go as fast as you need to go. So the cost of avoiding the risk was too high. So when you decide to avoid a risk, you also need to think of what am I giving up in order to avoid this risk. That's why I say most of the time it's very difficult to avoid a risk. And therefore, that's why then reducing the risk sometimes is more practical. Rather than avoiding the risk. If it's within your means to reduce the risk, you should reduce it. But sometimes it's not within your means. Some of the risks are from external events that we have no control over. Like you could have your car parked outside and then there's a hailstorm, and you can't control that. Although by putting a car in a covered pot, you are reducing the risk. So you would then weigh the cost of reducing the risk, so buying something or building a garage to protect your car from hailstorm versus the risk of your car getting damaged from hailstorms, to then take a view about what you want to do about the risk. So there's things like maintaining an emergency fund is an excellent way to avoid risk. I hope that topic was covered during the budgeting talk earlier this week. It's one of the most effective, because once you have an emergency fund, then it means whatever type of financial event that can happen, you at least have a way of getting by for 2 or 3 months. But there's things like maintaining a healthy lifestyle, which then reduces the risk of you, say, getting a heart attack, which could be a financial shock. There is things like maintaining a good credit score. It's a risk management method because in the case that you are in the red financially, at least a good credit score ensures that you can access financing to help you with that financial emergency that you have. So, and just generally living within your means is a good way to reduce your risk. But the important thing is to note that there are risks that we can reduce, and where we can reduce and the cost of reducing them is not too high, we should do it. So even things like putting burglar bars in your house to reduce the risk of theft. So those are other than taking insurance or before considering taking insurance, these are things we should be thinking. What risks am I facing? Can I avoid it? If not, can I reduce it in some way? Or in some cases, you could say, no, the risk is low enough, therefore I'm gonna accept it. But where a risk is too big to avoid, too big to accept, where a risk is too big to accept, and you've done all you can to reduce it, and you can't avoid it, and even after reducing it, the risk is still high, the only other thing to do is to transfer it to someone else, right? Because you've done you've concluded that the risk is too high, so something must be done. You've done all you can, but the remaining risk is still too high, therefore you give it to someone else. Giving it to someone else doesn't mean insurance per se. There's reciprocity, which is how humans have been surviving for thousands and thousands of years, which is the idea that when I'm in trouble, you help me, and when you are in trouble, I'll help you. So that's how our ancestors and their ancestors survived risks, by knowing that my neighbors are there for me. And so in the church context, that's an important point, that we can't be fellow church members when we allow people to suffer alone, right? And I know that we all have our own budgets, we all have our own priorities and so on, but let's try cultivate that spirit of reciprocity to say, if so-and-so is in trouble, let me come in for them, let me show up for them, because I know that when I'm in trouble, they will show up for me. So that's one way of transferring risk, because by showing up for someone, I'm taking on their risk, and then when they show up for me, they are taking on my risk. A way of formalizing that, things like burial societies are doing that, but in a formal way, that we all have an agreed thing that if one of us needs a funeral, everyone will chip in. So burial societies, this is how our parents used to survive before insurance existed in South Africa, stokvels, investment clubs. So there's many ways that we as people can share risk and transfer it. And then the most formal way, of course, of doing it is to give it to an insurance company. So that is definitely one option. One interesting thing, so this is a picture of, it's an artist impression of ancient Babylon. I discovered that the earliest known insurance contract was found in Babylon. Why Babylon? I was very disappointed. I was hoping for like Zion, like a respectable place, so I could be proud to be an insurance practitioner. But yes, the earliest insurance contract was found dated 2,000 years before Christ in the ruins of ancient Babylon. It was in the context of shipping. It was someone had given a loan to a shipping company to say, okay, you can go and buy goods and come sell them, and then with your profits, you can pay me back. But there was a provision that if the ship sank or the goods were stolen, then the person did not have to pay the loan back, and then they were charged an additional fee to protect. So the idea was to protect the shipping company or individual from the merchant, the shipping merchant, from financial ruin in the event that the ship sank or the goods were stolen or something happened. So that's an example of a very ancient example of insurance, and I thought that was quite interesting. But we are not in Babylon, here we are. The question is, if you accept that there are risks in your life that you want to be prudent and do something about, you've done all you can to reduce them, you've done all you can to avoid, there's some that you chose to accept, you've done all you can to avoid some, you've done all you can to reduce some, but there's some uncontrollable risks. The first thing to note is we are all different. So there's no, I know people like saying this, that, you must get blah, blah, blah insurance. Sometimes correct, but often not, because we have different circumstances. There are people here who are young and single, they are newly married people, they are mature families with assets, they are mature families with fewer assets. So there's like your present circumstances are different, and then your future is also different. Because already, even if you're a single person, maybe you're a single person who plans to get married next year, or you're a single person who wants to study maybe and not get married yet, or you're a young couple who's already pregnant, or you're a young couple who wants to stay. So the circumstances are different, therefore risks are different, therefore insurance needs are different. So the one thing that then makes insurance complicated is the fact that we need to start by understanding your own context and your own needs, so as to understand what are the things that put your income at risk and what are the things that create the risk of unexpected expenses. You can see time is moving. And so it's a hard question to answer simply. What I'm going to do is just I have given 6 examples that cover a spectrum from things that happen to almost everyone on a regular basis to very rare things like death. And then in all of them, I want to answer the question, what is the impact on your income and what can you do to protect it? And then 2, what is the impact on your budget, as in what new expenses would be created if this thing happened, and what can you do? The idea is to give you a feel for the different types of insurance products that are available out there, in the hope that you can pick 1 or 2 and say, that case kind of applies to me, and then you see what kind of product would work for you. I don't think I'll be able to cover the whole universe of insurance products that are available, but I'm hoping to give you like a highlight of the different types of products. So the first thing I want to start with is short-term. So let's just go up to go through the events types. So I'm going to cover kind of short-term medical events. So something like you found out that you need surgery and therefore you're going to go into hospital for 3-4 days, so a short time. Then I'm going to cover more long-term medical events. So you're like in a car accident, you've got severe injury, and you're not able to work for 3 months. What most people don't know in that case is your employer gives you sick leave for 30 days. So you'll get your salary for 1 month. If you are in hospital for 3 months, you'll get your salary for 1 month. So already 2 months, there's nothing. Question is, then your income is at risk, therefore. And then there's the cost, of course, of hospitalization for such a long time. What can you do? Then there's more serious things like a major medical diagnosis. Being diagnosed with cancer is like a terrible thing, emotionally for the family. the treatment is painful, but again, you may not be able to work for some time. There may be, usually for something as serious as cancer, most medical aid will not cover all the costs. And so the question is, what do you do about the additional costs? Then there's death, of course, which normally that's what people think about when they think about insurance. I chose to put it lower because I actually think we make a mistake by focusing on death. I feel that these things that are above the death line, they are more likely, they happen to people more frequently, and you find that people are not prepared. They just have death insurance, but they didn't think about getting injured and being out of work for 6 months, you know. So I feel, and you find that actually it's cheaper. So insurance for some of these other events is cheaper than death insurance. So if it were me, I would say, you know, reduce your death cover and rather spend some of that on things like cancer cover, so that at least your cover is more balanced. But we'll talk about that. Then I took 2 examples of property damage. I'm more of a life and health actuary, so I'm not really an expert on the last 2 lines. So I'll just touch a little bit just to give you a complete view. So yeah, starting with short-term medical emergencies. This stuff happens very often to people. Obviously, we all hope, like I said at the beginning, all of us hope that it won't happen to us, but even the guy it happened to was hoping it doesn't happen to him. So we need to be prepared. And the question is, obviously, there's no impact on income. If you are admitted to hospital for 2 nights, you will get sick leave, you'll get your salary in full, unless you are someone who gets paid per day. But even then, you only lose 2 days out of 30, so it's not a major crisis. But there is a high cost. If you want to avoid the cost, you have to go into the state system. And I don't know about you, but I want to avoid the state system. So if you, like me, want to avoid the state system, then usually you need medical aid, right? If medical aid is too expensive, the minimum you can buy is what's usually called a hospital plan, which usually only pays for if you get hospitalized. But actually, it pays for more. It pays for anything related to hospitalization and what the government calls prescribed minimum benefits. It's quite a long list of 26 conditions. And usually, it's like if you get diagnosed with high blood pressure, then they'll cover the doctor visits related to that, the medication, and anything that needs to be done for treatment. So usually hospital plans are quite cheap. I'm putting it to say, if you're really concerned that medical aid is too expensive, I really think you should try get some, because you don't want to find yourself having a medical emergency and then not having cover. And if really finances are a problem, I think a hospital plan is okay as a basic cover. Obviously, if you can afford to get more, you should, especially as you get older. The idea is health costs typically, when you're young and you're in your 20s, you literally never get sick. When I was in when you're under 40, probably, you will mostly just get a cold. But as your age increases, then stuff starts to happen inside your body. And so the need for comprehensive health insurance becomes important. I'm giving a NB or a warning. There are products that are floating around in the market. They call them medical insurance. There are these so-called hospital cash plans. My advice, and I'm not allowed to give financial advice, but my advice is stay away from them. They don't help at all. They don't really cover what you need covered. The people who sell them say, oh no, this is something cheaper for someone who can't afford medical aid. But you only find out when you need to get into hospital that this thing wasn't meant to help me. So my view, try get medical aid, try get a hospital plan. If you can't, rather just settle for the state system. Don't buy these medical insurance and hospital cashback plans for every day in hospital, they don't help at all with the costs that you'll incur. Then the second type of emergency that could happen, as I said, long-term injury. This stuff happens, especially in South Africa where road accidents happen quite a lot. So the risk that you don't work for a certain period of time due to injury is higher than you may think, which is why then there's products called either income protection, some people call them income continuation. They're actually quite cheap, especially for a young person. So really important to get. Usually they'll check what you earn, the salary, and then you'll choose whether you want, if you're injured, they'll pay your full salary or they'll pay half your salary or 75%. Like I said, they are really, really cheap, and it's worth getting. For most employed people, this type of product will be part of your group benefits, I think they call it, or employee benefits or group life. But you should check the conditions because my sister had a similar crisis of sorts, and she was with the government employees pension fund, and then I went and checked their conditions, and she wasn't covered. So it's most employed people are covered, but you never know. So you better check whether income continuation is there. Sometimes it's there, but they'll only cover you for like 6 months, and so you need to top up a bit. So I know people, we don't like reading this stuff, but usually on the intranet at work, there's a part for employee benefits. If you're lazy to read them, WhatsApp it to me. I'll charge you, maybe. But I'm happy to help if you like really confused. It's important to know what you covered for and then whether there's a shortfall so that you can top up. And then medical aid, of course, will cover the actual expenses of being hospitalized. Because if you are injured for a long time, you need both the hospital cost, but also to replace the income once you move out of sick leave at work. There's also something called capital disability, where if you get like seriously injured, then you can, then you need to like make your house wheelchair accessible, that kind of thing. Again, very cheap. I like these products because they are not known. Like I said, people normally talk about funeral and life cover. So people don't really know about income protection, capital disability. But usually for a really, really small amount, you can ensure that if something happens, you cover. Like I say, in most cases, your employer already gives you some of this cover. Just double check. And then if you're not covered, I promise you, it will be super cheap to get some basic cover here. And you'll never know that it's useful until the thing happens to you. Another event that could happen, of course, like I said, it's a serious diagnosis, like a cancer diagnosis. Here your problem is that usually medical aid, like the most medical aids to control their solvency, they will have caps. So they'll say, we'll help you if you need a coronary blah blah bypass, we'll help you, but only up to number X. And then you need treatment after that number. And you don't want to be in a situation where you need to leave hospital because your medical aid doesn't cover the shortfall, or a situation now your family needs to like sell the house and do drastic things just to ensure that you get some cancer treatment to avoid all that complication. Again, very, very cheap. This one is only this so-called critical illness cover. That's the one that normally pays out if you get a stroke or cancer or heart attack and that kind of thing. It's only cheap if you get it while you're young. If you get it while you're young, like it's super cheap. But as you get older, obviously the risk of a heart attack and so on increases. And the insurers will assume, if you get it when you're 50, they assume that you're getting it because some doctor told you that you're at risk. So they need to charge you accordingly. But if you get it and you're 25, they just assume, well, you're just a a responsible person, so the premiums are quite cheap for a young person. So the reason I listed critical illness income protection and the one I called capital disability is that they're fairly affordable, and they provide a lot of help when you have an emergency you couldn't plan for. I'm running out of time. Then there's the famous life cover. I think this is well known. In South Africa, it's the most popular. When people say insurance, people think of either funeral cover or life cover. My agenda is to, like, if you have 1,000 in life cover, I would cut that to 500 and move the other 500 to the other things. Sometimes already that's the case. Like if you were sold your life cover by a responsible financial planner, they made sure you have income protection, you have critical illness protection. But if you don't, and you don't want to spend more money, rather reduce. And one way of reducing life cover is to replace it with term life. Term life is life cover that lapses or stops at a certain point. The reason it makes sense, actually, is usually when you take life cover, it's to make sure that your debts when you die are covered. But most people, we don't have debts for life, right? By the time you're like 50, 60, your house is paid off, your car is paid off, so you no longer have debts. Number two, you take life cover so that your kids, that's the most important thing. You don't want to die and then, while your kids are dealing with the trauma of losing a parent, they now have to leave their school, they now have to leave the house because no one is there to pay for those things. So you do it so that you can secure your kids, but your kids are only dependent on you until they are 25. If a kid is after 25 and they still need you, there's a problem there. But okay, let's say 30 to give them a bonus, extra safety thing. So if your kid is 10, they only need you for 20 years. 40, but 40. No. I'm not there. I'm not doing that one. If by 32 you not have your life together, you were unlucky. So then there's a valid argument then to say if I'm taking life insurance to ensure that my kids are covered, then I could take it for 20, 25 years because after that they should be okay. And usually term life cover is really cheap because most death usually happens when we in the later years, right? Like when you're 70 or 80. So the cost of life cover is driven by the claims that happen in those ages above 65. So if you say, no, I don't want whole life cover for, let's say, 1 million, I only want it till I'm 60 because by then my kids should be independent. The cost will drop by more than half, you see, which then releases money to maybe bolster the other things. But what's funny in SA is that the agents, the brokers get commission for more commission for life cover. So they won't tell you about term life, but if you ask them, they'll tell you. So I would say, in most cases, most people, you don't need full life cover. You just need term life up to age 65, unless you're someone who's passionate about inheritance, you see. Because we copied the British system by selling whole life cover. And the reason the British did it that way is they believe strongly in inheritance. So the old granny wants to leave, 10 million for her grandkids and is willing to pay for that. But someone might say, no, but if my house is paid off, then my house will be my kids' inheritance. I don't need to then make sure that on top of that they get something. Therefore, I'll only cover myself until they're independent. So those are the options that one needs to think about. What? Okay. The last point, there's a popular product. Whenever you buy, you take a home loan, or you buy a car, or you take credit, they usually force you to take this so-called credit life. Credit life is there so that if you die and you still owe money, then they don't have to take back the car, policy pays. So what you can do, rather than pay that extra 200, is take even the life cover you get at work. If you take that and say, look, I have life cover already, the National Credit Act requires that they accept that and don't force you. So you can just save. Usually credit life is cheap, like 200-300, but I mean, if you have a bond and a car loan and maybe other loans, they add up. So which means with just the group life cover from work, if you just show that, you don't have to keep taking all these other credit lives. That's just something to be aware of. And then there's the property insurance. Like I said, I'm not really an expert. What I've learned, though, about this, where like insuring your house or your car is, the important thing is disclosure. So they usually ask you a lot of questions, like they'll ask you what's the value of your house, what's the value of the things in your house. And people usually under-disclose in order to save money. But if something happens, then you said the value of the contents in your house is only 100,000 when you knew that just the bedroom is 100,000. So now your payout is small because that's what you disclosed. So usually, if you don't want it, rather don't take it. If you take it, rather disclose everything so that you have adequate protection. But I won't say much about it because it's not my field of expertise. Then, like I said at the beginning, your needs depend on your circumstances, but circumstances constantly change. And therefore, there's a need to constantly, when you get your first job, your insurance needs are one way. Then you meet a guy, then your needs, and you marry the guy, the needs change because now you have a family, maybe you own property together, and then you have a baby, now your needs change because now there's this person that you want to support for, you said, 40 years or 30? You want to support for 30 years. So the trick then is whenever your life circumstances change, you need to double check whether that new change, for example, there's a lot of parents who insure their first child, but the second child they kind of forget about, because they think they are done. But you do need to keep double checking the level of cover. Then the last question I want to explore is, or second last question, is this issue of there's so much choice. We've just talked about the products you could buy, and already I named so many, and someone is sitting there thinking it's way too much, Then you have the brands. For each product, there's 20 brands to choose from. It's a hard one. I would, if you're buying very simple and you know exactly what you want, the trick is then pick three brands and just go to their websites and get 3 codes, and then you're done. If you're not really sure, then of course you should try get a broker. You need to know the difference between, there's brokers and there's agents. An agent usually works for one company, and no matter what you want, they'll only sell you stuff from that one company, which doesn't really help because they won't shop around for you. Whereas a broker will shop around for you. So you need a broker more than you need an agent. If you're not really sure and you have a lot of questions and you feel that the space is too complex, and you can brief them to then get you 3 codes, and they can even explain where the codes differ, etc., etc. But where you know exactly that I want, life cover, I want it for this much. And I forgot to mention, so the question of how much life cover you should get, the trick is it's the total value of your debts or credit, because like I said, you don't have to get credit life, you can just use your policy. So the total value of your credit, and then for income, they say depending, like I said, if you believe, like me, that you don't need to support your kids forever, then it's 10 times your annual salary. If you want to like really support your kids beyond their say 30th birthday, then you can, you need much more. You need, or you have a spouse and you're a single income family and you want to then support your spouse till they die, then you need like 20 times your annual salary. So I'd say if you're a 2-income family and you don't really have to support your kids for that long, I'd say 10 times your annual salary is the insurance you need. If you are single income and so there's someone, if you die, who will be left needing that support, then 20 times. So it depends, and a broker or a financial advisor would help you make those decisions and choose the appropriate amount of cover. So depending on whether you're sure of what you want, if you know what you want, just pick 3, go to their websites, compare, get it done. If you're not sure, find a broker, not an agent, and just get them to get you the codes and to explain the differences between the codes. In closing, then, I want to tackle the question of Adventists and insurance. So this one is just for the Adventists in the room. So these are some of the codes that people have used to make the argument that no, as an Adventist, you don't need life insurance. So if you look at Ellen White's writings, you'll see that she was in strong support of property insurance. That's the first 2 codes. I mean, if I just read the second one, Brother Palmer says he has written to you in regard to the insurance. If the house is not insured, it should be insured at once. So you can see she had a strong view that you should do this. The reason was their houses were built with wood, and then you would have a fireplace and a stove in the house made with wood. So you can see that the houses used to catch fire quite often. So it was quite clear that fire protection against fire is important. But look at what she says about life insurance. I was shown that Sabbath-keeping Adventists should not engage in life insurance. This is a commerce with the world, which God does not approve. Those who engage in this enterprise are uniting with the world, while God calls his people to come out from among them and to be separate. So this is an example of many. It's one of many codes that show a very strong aversion to life insurance. So the Adventist Biblical Research Institute then published a book. Well, it's more of a paper, but it's really long. So it's more of a book. It's there online for those who want to read it, where they analyze those statements and try to figure out whether they are still applicable for us today. And their conclusion was those statements were applicable to the context at the time they were written and do not necessarily apply to life insurance as it manifests today. Let me read the quote that I'm sure you're also able to read. The post-Civil War period was a time of rapid expansion in the United States and in technological innovation, an age of rampant opportunities and speculation, virtually unregulated by government. Then they go on to describe, the practices of life insurance at the time. The insurance industry was fully involved in the spirit of the time, a spirit steeped in the essence of high risk. Undercapitalized insurance stock groups, while promising quick wealth, frequently collapsed without notice, leaving their policies worthless. Company dealings with their customers were often unjust and infrequently fraudulent in nature. So, and it goes on. So you can see that the problem was not so much insurance as a concept, but the practices of insurers of that time, that there was a lot of, although someone could argue there's still some of that in the financial industry today, a lot of fraud, so because of that behavior, then she cautioned to say, rather don't waste your money on this. And I mean, today, I think the world has come a long way. There's a lot of regulation to protect policyholders, but it's not perfect yet, right? There's still people who go paying premiums for a long time, and then when it's time to claim, nothing gets paid out because someone found a loophole somewhere. So it's not perfect, but I believe that if you compare it to the state of the industry at the time the statements we just read were written, you would understand why she would speak with such strong language. And the conclusion of the Biblical Research Institute was that the statements don't apply to the present context, even though there's still a need for further improvement. I will give it a pause. I am well over the time, 10 minutes over the time, but I hope it was valuable. I hope I've given you some enlightenment and managed to demystify the industry a little bit. We're going to have questions now, and then, of course, if you have further questions afterwards, we can talk. Thank you.